So let's do a bit of a recap depending on, there's only one particular assessment criteria to cover, but let's see depending on, how quickly and how much do you understand accounting and finance terms. So let's look at, doing a quick recap in terms of what we covered last time. So I think if you recall, what we did last time was we started off this particular unit, which is how businesses operate. And in this, we looked at 3 or 4 different aspects. So one, we understood, how businesses are structured. So in terms of ownership. So when we look at, when we look at different types of businesses, different type of companies, we talked about private public sector. Within the private sector, we talked about different classification of companies, things like sole traders, partnership, limited company, limited liability company. And we did a bit of a exercise sheet, which was primarily to look at understanding, let's say the, ownership of different type of businesses. So when we look at this, we just briefly looked at this table, and with that we did a bit of classification. The second bit that we covered was the different type of structures. So in this case, we looked at different type of structures which can be formed within the company or in an organization, and they were 4 different types that we discussed. So these structures were, flat structure, hierarchical structure, matrix structure, and divisional structure. And we took some examples of companies, like Hewlett-Packard, HP in general. We looked at Apple, Microsoft, and we discovered that, various type of structures that we look at can be oriented, depending on how the company's operations are in a particular geography or in a particular region. And then we looked at some of the basic factors which actually affect company and company operations, which is look at the economic environment. So things which are within the control of the company, which is micro, that means internal. We also looked at macro, which is outside the control of the company. So there we took an example of Brexit, currency fluctuations, if businesses are doing import-export, if the dollar or the pound rate changes and exchange rate varies, it affects how you get the pricing of the products, whether it becomes expensive or it becomes cheaper to import. And then what we did was we wanted to look at in the merit activity, how do we differentiate between 2 businesses depending on their objectives. So here you have to look at taking a sole trader or maybe a partnership or a limited company in one sector and compare it with the limited company or another type of company in another sector. So it could be like, what are the differences and how objectives are different for different companies. So when I look at a sole trader like a plumber or electrician or a small grocery store, what we do generally find is their objectives in terms of running the business obviously is to make profits, but it is different from how they set their short, medium, and long-term objectives. And if you compare that with a different organization like a Tesco or some of the other large companies which are limited companies or public PLCs, where we see that they have to keep objectives on the basis of stakeholders. So what would be the objectives which the board sets, and these objectives then take into account the requirements of employees, partners, suppliers, shareholders, and different third-party contracting agencies, and that is what has to be done in terms of merit. And then in distinction, the task was to look at picking up a particular organization, but within a country, and analyze the current and global operation for that organization. So here again, an example of, I would suggest, what you've done in the merit activity would be to pick that if you're comparing, say, a Tesco, and then look at how they operate within the UK and how they operate, in the European Union. And that would mean that we look at taking into account PEST as a framework. So when we look at PEST as a framework, what I would do is basically send you a bit of a handout, and this PEST, would basically look at giving you a bit of an idea in terms of how you can look at, analyzing the, say, business environment, how it affects the particular company. So let's look at political factors in the UK, a lot of uncertainty because of Brexit, a lot of businesses are looking at, stockpiling or, looking at placing orders. And this is because most businesses who trade with Europe actually fear that if there was no deal is to happen, then their prices and their supply chain lines would be affected. So here we will do something like a PEST to do this current analysis in terms of how the local and the global environments actually affect the business. So PEST, Yeah, that's something that we have not covered, but that's an activity that you'll have to look at by doing the distinction task. So PEST would stand for, political, E stands for economic, S stands for social, T stands for technological, L for legal, and E for environmental. So these are changes which can affect the business in the current sense, both within and outside. When I say within, means local operations in a country, and outside means global operations, and how these factors affect will have to be looked at using one of this framework. Either you can use SWOT or PESTLE, but PESTLE would be the most relevant framework to use to complete this particular activity, PESTLE analysis. Yeah, and we've got several examples of how PESTLE analysis has been done. Just to share with you as an example, when we look at the operations of Tesco, which I'm giving you an example of, as one of the learners has done, you generally see that they operate in 13, 14 countries. So here the idea has been that using PESTLE as a framework, we have, or the learner in this case has looked at how they are looking at their global operations and how they are looking at expanding their operations within the UK. So individual factors, have been assessed. And the idea here is that you're looking at picking out, say, when we look at political factors. So political uncertainty is related to Brexit, as an example. And here it is not just affecting Tesco, but also affecting Sainsbury or, Lidl or, Aldi and all the other retailers, because that creates uncertainty around policy, around government legislation. So when we look at economic factors, it would be things like, currency exchange. It could be factors which are related to, import-export legislation. It could be to do with, whether Britain gets a deal in the Brexit or doesn't get a deal, and that would, to a large extent, determine, the taxes that we will need to pay if we do not get a deal within the EU. So economic factors are going to be related to, policies which are primarily going to affect businesses from a point of view of, let's say, currency. It could be economic policies. So if, I don't know whether you recall, but in a couple of days back, the Chancellor of the Exchequer, Sajid Javid, basically said that we are not going to be closely following European Union on any legislation when he announces the new budget. That created a bit of a scare in the market, with the company saying that, okay, what will happen? That means today we trade without any taxes between mainland Europe and UK. But if that is not to happen, then that would mean the prices on the retail shelves or retail stores would increase for the consumers. So that's an economic factor. That means inflation will go up. So economic factors are related to government's monetary and fiscal policy, things like inflation, things like currency, and that would mean that if the inflation is to go up, then the things in the market would start becoming expensive, and with things becoming expensive, that would mean that basically the prices will increase, and the customers will have to pay an additional amount, to look at getting the goods that they really want to buy. So I think that is the bit that we have to look at when we look at economic factors. Similarly, social factors. Now, social factors tend to be things which are related to, what do you think would be social factors?
Social factors such as is generally the people around the business.
Correct. So when we look at social factors, what we are looking at primarily, when we say social factors affecting business, so these social factors will include things like customs and beliefs and culture. So, for example, when I look at certain customers in the market do not like certain types of goods. So when we look at demographics, when we look at your caste, culture, basic beliefs of consumers. So we talk about the behavior, for example. Then yeah, correct. So in this case, what happens is basically what you will see is that sometimes you will see that customers during the festive season would want to buy certain types of goods. So if it's Easter, there will be a certain type of things which will start increasing in sales, and the stores would actually stock most of those things. So when we look at social factors, what we are here talking about is social factors for business include things like lifestyle, personality, behavior of the consumer, the attitude, towards buying certain types of products. That is what these social factors tend to be. So one of the factors that we've talked about, which relates to lifestyle and attitude and personality, is that a lot of customers today buy online because they find it convenient. They find it easy to do comparison between the two different type of products or prices, and then they have the option to compare and then get an option of choice. So socially, if you look at, the companies have to look at this trend that a lot of buying is now moving online. Correct? That means if customers like Tesco's do not look at their own customers in terms of their buying habits and behavior, that they're looking at buying online, placing orders, and you have deliveries happening at home, then they're losing out on the business. So these would include, social factors. Technological factors, as the name implies, technology means, if they have to upgrade their system, make the servers fast. If you're opening a new store and there are, say, 20 still machines to be installed, and all the data is being fed back into the Tesco Club card. If they do not have a system like this, or if competitors do not have a system like this, then Tesco has an edge in terms of technology because you can understand the buying habits of the consumer. So you go to a shop, every time you buy grocery, egg, bread, butter, milk, vegetables, other things, chips, whatever you buy. So it's all getting scanned into the barcode. But towards the end, when the data reaches the server and somebody in the office is actually looking at analyzing what is your weekly shop. So in the end of the month or in the end of the quarter, when you get some coupons coming in, discount coupons, they are based the fact that they are based on certain products that you're buying, and that is being used or tracked using technological as a factor. So today, no business can afford not to have a fiber connection, isn't it? So when we talk about connectivity, when we talk about speed, productivity, most businesses need to have fiber within the office. And the reason of having fiber, internet, broadband fiber, is to ensure that their communication is faster, easier, and quicker, and there is no lapse in that communication. So from that point of view, that would look at in technological factors. Similarly, economic, environmental factors. When we look at, we talk about a lot of things that when you see McDonald's advertisement nowadays, it says we use British farm foods, or we use British beef and things like that. What they're trying to say is that we are trying to. Sometimes when you go and buy eggs from the market, you see there are eggs which are organic eggs. There are eggs which are basically the chickens are let out and all that stuff. When they talk about is basically environmental factors or organic farming. They are talking about how is the store operating in terms of its carbon footprint or the kind of pollution it may have, or the kind of material they send across to the landfill. So when you look at these kind of things, they are going to be environmental factors. Now, how would I test this environmental factor? That European Union has put in a legislation in place that by 2024, all retailers, Carrefour, Metro, Asda, Tesco, all the big retailers that we look at, have to then become self-sufficient by 2024-25. That means they should produce 70% of the electricity in the stores using solar panels, wind energy, renewables. They have to reduce the carbon footprint. They have to reduce their, waste going to landfills in terms of, under the estimate, which was a report which was done by Retail Invest, which is one of the companies which does research on this. They found out 1.1 billion pounds of food, fresh food and grocery, is actually going to landfill every month from the retailers. So on one side we have scarcity of food, droughts, people in other places across the world are starving. But on this side, if you look at the kind of waste, big retailers are actually producing, the big four, what they've done is they produced a legislation which says that the amount of waste that they send to landfill has to be reduced by 50%. And that would mean that when you go to Tesco's, how does this change happen? Is the change that when you see there are marked up dates on all the products. So if the product goes or it's coming to that particular date, they put some sort of an offer on it to say that, okay, this is at reduced price or it's on reduced prices right now, because they want to make sure that it gets sold rather than that material being sent to the landfill. And then when you look at legislation, factors, this is talking about things like competition commission. So what would be legislation to look at ensuring that they have a fair playing field. Sometimes what would be the news, if I speak to the example of Tesco, would be the fact that what tends to happen is that the big four are trying to mass hoard the land. That means they're not allowing smaller retail shops, grocery stores to take a foothold in the cities. So what they do is they open a new large format Tesco or a store which drives away the local business. So in this case, the Competition Commission looks into by introducing legislation saying that they force these large retailers to sell unused land or places wherein they have not been able to commission a store or open a store, and that is all due to legislation. Things like working time directive that most people in the stores need to work only 37.5 hours. You look at equal opportunities, no discrimination on the basis of caste, culture, creed. Those kind of things are all under the case of legislation. Do you recall that Tesco was also under a bit of a scrutiny because their financial directors had over-reported profits, and the Competitions Commission actually fined Tesco for over-reporting profits by which is a fine they had to pay because they over-reported profits to kind of artificially pump up their balance sheets by 170 million. So this was a news which obviously was in the papers. Tesco reports. Or say Tesco over reports profits in financial year. So there was a big case which went across, and obviously, they were fined, and this was something which is something which is the legislative process, which is taken care of by the Competition Commission, wherein companies, if they fiddle or serious frauds office when they overstated their profits by 129 million in 2017. So they were fined. The commercial directors had to resign, and this is something which the competition watchdogs looks into. Or some of the quangos that we discussed, like the gas agencies and things like that. They look at this by enforcing the government legislation into the market. And one of the agencies which does this is primarily the competitions watchdog. So that is what was the learning outcome 1. And today we are going to go into and study, which is learning outcome 2. And here we want to know what is the importance of accounting in business. Why accounts are important, why finances are important, and this is what we need to actually look at studying in this particular learning outcome. So here, the idea would be to understand some basic terms in terms of, what is accounting, what are the different types of accounting, how companies produce financial statements, what kind of statements are these, what is profit, what is loss, what are ratios. So this learning outcome is purely theoretical. So here we have to cover the definitions, primarily most of the key terms that we come across, when we talk about accounting or accounts or finance as a department within a business. Is that okay?
Right.
What I've done in this case is we are going to go through a bit of a presentation, and that presentation basically has some of these terms that we're going to go across and learn from a purpose and point of view of understanding the importance of accounts and accounting statements within a business. So let's look at accounts. Now, first thing, when you think of accounts, how do you define accounts, or what do you think of in terms of when you say accounts for an organization? What does come to your mind when you talk about accounts and finance?
Finance, numbers, database, and they keep records of all the financial stuff of the business.
That is correct. So accounting would be a technique or a process through which a business would keep track of its transactions. That would mean that it's a process of systematically analyzing different forms of transactions and interpreting data which is collected in some shape or form within the company. Now, when we look at the process of accounting and how is it used in the business, and in general, when we say the role, what is the role? I think in general, when we talk about the role of accounting in business, we are talking about things like understanding the financial information which is important for certain types of stakeholders. Now, what are these stakeholders? These could be employees, it could be shareholders, it could be the board, it could be banks, and all these kind of people who are essentially having some sort of a vested interest in the company and its accounts would be classified as stakeholders. So here they would want to understand how you sell, how much do you sell, what the company makes in terms of profit, who are involved in the sales process, and then what is the income which the company is able to derive by doing certain activities of selling products and services to consumers in the market. So let's look at some of the accounting terms that we come across. Now, accounts could be a group of items having common characteristics. Now, that would be a definition of how we would classify, just by saying, the term accounts. Now, there are different types of accounts. When we look at accounts, one would be accounts in the form of, assets. There could be accounts in the form of, income, equity, liability, and expense. But generally, when we talk about different types of statements in terms of accounts, we talk about things like, if I just quickly open this up and type it down. So when we talk about the different types of, statements, what kind of statements have we heard about? We've heard about balance sheet. We've heard about profit and loss account, correct? And we've also heard about things like cash flow statements, or we've heard about things like working cash flow statements. So these are usual financial statements that we come across when we talk about accounts or any type of such, records that a company would maintain. And the idea of the company maintaining this record is they want to keep a record of the transactions which are happening, which are or are being generated from an activity. It could be a selling activity, marketing activity, any sort of products and service being sold to the consumer, which is an activity, and this generates some sort of financial value. So when we look at these financial values and terms and, basically money being generated, at some stage the company has to calculate how much of profit did I make, what is or if the profit has not been made, what is the loss the company is making, and those have to be then basically looked at putting into some sort of statements, basic statements. Now, when we look at reasons of accounting, why do you think you would look at accounts? Or let's look at a simple example in this case. If your mother or your parents at home maintain some sort of a monthly account, there's a certain amount of income coming in, which is in the form of salary or, wages, or in terms of profits that you're getting from your business. And then against that, what you do is you put some expenses in. So that means your expense for rent, maybe school fees, grocery shopping, some of the things like rents for your, say, Sky or cable, your telephone bill, electricity, water. So what the normal person in this case does is you look at certain incomings, which is your salary or wages or profits or dividends or, interest costs which are coming in from your money in the bank. And then what are your outgoings? Outgoings could be in terms of bills, expenses that you're incurring and you're paying against that credit card bill. It could be water bill, electricity bill, rent, mortgage, whatever it is. Now, at some stage, somebody in the house would be interested in finding out whether my incoming is higher than what my outgoing is, or am I making them saving, or am I overspending? Isn't it? Yeah. So when we look at that, in those cases, what we are looking at is we are using, in a way, accounts at home as well, and that is primarily to look at the process of managing finances, calculating how much we are spending, how much we are getting, what is the spend that we are doing on food, what is the spend that we are doing on, say, rent, electricity, different types of expenses. We are also looking at predicting how much of this would be next month. So when you get a water bill which comes in 6 months, or when you get an electricity bill at the end of the quarter, how much is the estimate on the bill going to be? So sometimes you end up asking these questions, to people when they are looking at switching your electricity or switching something, isn't it?
Yes.
Yeah. So basically here the idea is that you are looking at controlling any type of expenses that you would incur from time to time, because those are important for you to understand that this is something that I need, or I need to maintain, or I need to look at keeping a tab on. And when we look at that, that would allow us to understand very clearly that these are the kind of incomings and these are the type of outgoings. Now, let me throw something into the mix, which is in terms of understanding that let me say, if at the end of the month you earn a certain amount higher than what was expected, so at some stage what that would mean is that you will also end up paying some tax, which could be a personal tax, which that you will end up paying, and that personal tax tends to be the tax on say for example your income. So what is the in terms of just as a general knowledge, what is the the exemption in the case of personal tax nowadays? Any ideas?
What was that, Mr. Singh?
I'm saying, do you know what is the exemption on personal tax that you can get when you look at?
So as the law says, if you're under 18, it's less, and then above 18, it starts to become more. You have to pay for your weekly wage.
That is correct. So that would be primarily related to, I would say, the amount of what you get paid as.
Yeah, 100%. Yeah.
That would be what you get paid as. Yeah, what you get paid as. So in this case, what I would do is basically look at suggesting that when we look at people with different age and we look at people with different income levels, they get paid according to the tax or the income that they are getting. So when we say that we look at that as an aspect, what we are trying to do is primarily put them into certain categories. So if you are under the age of 16, you can get certain pay, which is say £3.60. When you're at the age of 19 and over, you get the basic wage pay. When you're over the age of 25 or 21, you get certain amount of pay. So that is that. But when we look at income and taxes, what we are looking at is, when we say income and taxes, what we are primarily here looking at is the case wherein we are talking about the rate of personal income tax. So if you earn up to £12,500 a year, then in this case you pay no tax because you are exempted from tax. Is that okay?
Yeah.
You are actually exempted by tax. So when we say that you are exempted from tax, that means if I earn 20,000, then what will happen? That anything which I've earned up to 12,500 will be deducted from 20,000, and I will be only taxed on my income, which is,
right. The more income you get, the more you're taxed.
Yeah, 7,500. So from that angle, that is where you will look at, your income or, your.
Does it happen to the whole house, or?
Sorry?
Does it happen to the whole house? The tax?
No, this is individual. This is on an individual basis, because what you earn essentially is what you pay taxes on. So if there are 4 members in the family and all of them have separate incomes, then in this case, what will happen is that you will end up paying income on what you're earning as a particular, income on the tax. It will not going to be that what you earn is you are being taxed, your father is being taxed, your mother. No, everybody is individual. So you have your individual insurance number, and that links to your particular income, or the money that you're earning from, or salaries or other sources of income. So here the basic idea was that the example that I gave you was primarily to look at, when we talk about finances and look at an example at home, we also do the basic process of accounting and finance at home when we look at our basic things of household activities, things like that you buy, things which you pay for when you use them, things like electricity, water, rent, mortgage, and those are termed as expenses. The salary that you get in your bank when you work for a certain number of days in a company or in a business, the salary that you get is basically classed as income. So money coming in would be classed as income. Anything which is going out from your bank account would be classed as an expense. So just the basic definitions of relating it to in terms of, how it is classed as income and how it is classed as an expense is what we will look at, just for the understanding of the term. Now, sticking to what I mentioned earlier, say, for example, which was the budget, I want to introduce a new term called budget. So when we talk about, your mother keeping, say, 200 pounds aside for grocery, or maybe 200 pounds aside for fuel, or maybe the rent and electricity is going to be 200. What she's trying to do is, from the income that has been received, or the wage that you receive, you're trying to kind of segregate that into different parts to be able to allocate that for certain type of activities, isn't it? Yeah. So if I say I'm going to keep aside 100 pounds for electricity, that means what you've done is you're budgeting it towards,
limited budget.
You're basically creating a bit of a budget to keep it towards, a particular activity. And when we look at that particular activity, what you're trying to do is, in a way, I'm going to class and put that into a term called budgeting. That means I will budget for, say, for example, if I just look at here, so the term that I want to introduce is, if I look at a bit of a budget, and let's do this on a bit of an Excel sheet, just to understand. If I look at an Excel sheet now, and open this up, so what I want to do is, I want to look at creation of say, a house budget. So this is, say, a house budget. What I would do is, I would say income, which is basically salary. Then I would say, I would class these as expenses. So let's look at certain terms. Let's look at certain terms, and you tell me whether this is income or expense. So what is wages? How would you class wages as? Is it income or expense?
Would it be income?
That will be income. So interest on fixed deposit, or say ISA. What will be that classed as? Income or expenses?
Tax.
Tax. Okay. So I'm just going to write TAU restaurant bill, movie ticket. I'm going to look at, say, gift card from parents. You would also say some salary from overtime, tax refund from HMRC. We look at things like Sky bill, PT telephone bill. We look at mobile phone bill. You look at a train ticket. So let's classify these into, whether they are income or expenses first. So let's look at what would be wages according to you. Wages would be classed as what type of thing?
Wages, income, obviously.
Okay. Electricity bill?
Electricity bill, tax.
Sorry?
Tax.
No, we are looking at just classification between these two, income and expense.
So
expense. What is electricity bill?
Expense.
When you pay electricity expense. What is water bill?
Water bill, expense.
Okay, what is interest? If you have a ISA or a fixed deposit in the bank and you get some interest on it, what will that be classed as?
Tax.
That will be classed as income. So if you have, say, £2,000 in your bank and you get some interest on it because it is the saving that you've done, every month that you get some, say, 10, 12, 15 pounds on it, at an annual rate of 2% ARR, that is an income that you're getting because your money is in the bank, you're not using it, and the bank is paying you some interest, primarily to, towards that money which you have actually put in the bank. So all these kind of things that I'm putting in expenses are actually expenses. So if you get a gift, say you get £50 from your father on your birthday, will be an income. If you get some extra salary, if you've done overtime, that will be your income. If you get a tax refund at the end of the year, saying that you've overpaid your tax or your employer has deducted more tax, and if this is coming to you as a check at the end of the year or in the end of the month, that is an income because you're getting that money back from the government. So when we look at certain types of heads, what I want to do is I want to look at various terms that we want to cover in this rather than through a presentation. Let's look at the practical aspect of it. So when we talk about accounting, we know why accounting is done because we want to keep track of a transaction. Now we are looking at different types of terms which are important in accounting. So we understand what is income and what is expense. So anything which is any activity from which you gain money, any activity which actually pays you money or you earn some money coming into your bank account would be classed as income. Any activity, any type of bill that you have to pay or which you utilize services would be classed as an expense. Now, when we look at budgeting, there is another term that I want to introduce, which is budget. So if I say that, as an example, my income, or you would say that income is £2,000 per month. Okay, so we're talking income monthly. Now, out of this, what you want to do is you want to pay your mortgage, you want to pay your bills. Now, bills could be electricity, it could be water, it could be BT, it could be Sky, it could be phone, mobile, whatever it is, right? So I'm just going to classify as bills. You have some shopping that you do for grocery, which is say you go to Tesco or grocery shopping, and you look at fuel, which is primarily either petrol or diesel. You then look at some shopping that you do on, clothes. You look at any school fees or anything that you pay, and then at the end of it, you look at certain things in terms of if you're, if say for example, when I say certain things would be, say if you take your family out for a dinner, you keep some money, or you make some budget for movies and dinner once a month. And then if you create a pot when you want to do savings. So what tends to happen is a lot of people will save 20, 30, 50 pounds a month, and they will set up a direct debit which will transfer money from their current account to their ISA or their savings account, and that is to save money for Christmas or for holidays or things like that. Now here, if you're looking at doing a bit of balancing, that means what you want to do is you have £2,000 which have come in as money. Your mortgage, for example, is 400. Assuming I'm just making a guess. You have your bills to pay, which is 300. You do some grocery shopping every month for 150. You keep 50 pounds for fuel. You keep say 100 pounds for clothes. There's no school fees that you pay. Dinner and movies you keep 150. You put 50 to savings, and there is no holiday that you're taking this month. So we are doing a budgeting for January 2020. So what will happen is, at some stage, if I put these here, this is income, and this is expense, right? So we've read these two terms. I'm bringing it here into a bit of a budgeting exercise. So what happens is, if I look at any other source of income, which would mean, say, if you stay as a joint family and if you're working, you get some, apprenticeship pay and you give it to your parents, for example, or you contribute towards the household expenses, I would put, say, 200, just as an example. So when I total this up now, what I'm trying to do is basically come up with a bit of a budget to say that this is my total incoming and this is my total outgoing. So your total income in the house, say for example, if your wife works, if she works part-time and she gets a bit of income. So I'm going to say she works and she gets a bit of income. And what I want to do is total that up to primarily say that this is what the income is going to be and this is what my expense is going to be. Okay? So, and if I say, I'm just going to add a few bits here, say I'm going to add 200 and fuel I'll increase to 150, grocery I'll increase to 400 or 300. And this is, so your incoming is 2700 and your outgoing, so this month, for example, you don't get anything, your wife only works. So your income is 2500 and your expenses are 2150. So how much of saving have you done? So you would have saved 350 pounds, right? Yes. This is an example of how we would do budgeting at home. If a small family looks at their budget and they look at what is the outgoing, what is the incoming, they are looking at doing a bit of budgeting to say, okay, this is what I get, and this is what I pay on a monthly basis, and this is what I'm saving. Okay?
Yes.
So this is an exercise of budgeting. Now, this same kind of budgeting is done by a business, right?
Yeah.
Whether it's a small business, big business, they also do the same kind of business budgeting. But what that budgeting would mean, so here in this case would be income coming from sales activities, right? And the expenses would be in the form of things like, so if I look at some of the terms in terms of expenses and income for a business, if I write income and expenses, would be things like salaries to employees. It could be the electricity or bills basically in general. It could be, let's say, insurance costs. It could be things like rents. It could be, what else could be there? Security. There could be tax, which the company pays, corporation tax.
Airport.
Yeah. Which could be VAT. So these are going to be the expenses for a business. The income is going to be, income is the money being generated from sales of goods and services.
And then there's net profit.
Net profit, yeah. So anything in terms of interest, which the company is earning interest on, money in the bank. If they have any profits which have been generated in the previous months and years, and that money is lying in the bank, they're getting interest on that money from the bank. So here, when you look at doing the company's accountant or, somebody in accounts and finance, if they end up doing budgeting, what they do is they will basically look at creating a similar budget, and that budget will look at all the activities which the company is doing, and that would be primarily, coming up in the budgeting for a business, correct? So income from, say, it's a small business, they get £100,000 a year. The wages, are say £40,000 across number of employees. They pay certain bills like rent, electricity, insurance cost is say 1,500 for the year. They pay some rent, which is 15,000. There is some cost for annual security maintenance, corporation tax, depending on whether the company is making profit or not, and then VAT also on the basis of whether they're making profits or not. So if I look at now, their earnings are 100,000 and their net expenses are 79,000. So, but on the sales that they do, they pay 20% VAT. So if I have to calculate this, VAT in the UK is 20%. So that means they would pay £20,000 VAT. And if the profit, if they sale, total income coming in is 100,000, that means they would have made a profit of, minus the expenses, how much? 100,000 minus 99,000. So their profit is 1,000 on the overall business in the year. And on this, the corporation tax is 19%. So the company actually will pay 19% corporation tax. And that would mean, sorry, that's circular reference. So what that would mean is that the company would have paid 1,000 into 19%, and the company would have paid £190 as tax, and that would mean that the business has had a net profitability of say £810 in the year. Is that okay?
Yes.
So from this budgeting, what we are able to come up with is things like net profit. What is net profit? Net profit is the amount of money or anything which has been saved after paying out all the expenses, including wages, salaries, tax, rent, VAT, everything. And that money is called net profit. That means that is something which the company has saved at the end of the year, minus of all the expenses that you can think of, whether it's salaries, whether it's rent, security, any sort of taxation from the government, VAT, everything has been included. Is that okay? So here, in this case, expenses in the terms of businesses would be called expenditure. Okay? So the term slightly changes from expense to expenditure. That means the money which the company has to spend in the market to be able to generate those sales. Now here, one of the things which I kind of missed out was things like, this is assuming that the company is doing no marketing, no sales cost. And if I add that in, to a certain extent, the turnover of the company would become negative. And that would mean the company has suffered what has the company done? Company has suffered a
Loss.
loss. Very good. So in this case, if I put, say, in the expenditure, the company spent £10,000 on flyers and other things, that means the net profit on the company was,
Decreased.
was actually a net loss rather than net, and that was, say, 9,190. And when we look at this, on a loss, you don't need to pay tax. So that means the tax in this case would become, because the company hasn't made any profit. So what we've come across in terms of the terms when we started off with budget is that we've come across terms like expenditure, net profit, net loss, depending on how the company's activities are with regards to, accounting and finance. Is this bit clear?
Yeah, Mr.
Yeah. Now, let's look at understanding some other terms like gross margin, net profit margin, right? And then return on capital employed, ROCE as we call it.
Right.
Now, say for example, if you're the director of a company and you are marketing a product, and when you market a product, you basically look at creating a product price. So for example, let's look at if you buy and sell cars, right? Yeah. Now, as a dealership, what you're looking at is, as a dealership, you want to look at how much of money can you make by selling each car. So how will you calculate that? You will calculate that by finding out what is the net cost of building, the product. Yeah. Or the product. So in this case, you don't know the net cost, but the cost of, say, the Nissan car, I'm talking about, say, Nissan Qashqai, this comes to you at £16,600, from the company. Now, I'm not too bothered what is the breakup of this cost, but you get this cost. Now, after this, at a dealership, they decide along with the company that what the car is going to be retailed at in the market. So there is something called, if you see, this is called retail selling price. You heard about something called retail price?
Retail price, yeah, the original price of the product before you buy it. And then
there is end user price, right? So in some cases, what will happen is, as a dealer, as the owner of the business, what you're going to do is discuss with the company that I need to pay this much rent cost, I need to pay this much salary, I have this overheads. What are overheads? Expenses, essentially, that you will incur to do the sales. Right?
Yeah, that's what then.
Correct. You have to do sales promotions, you have cost of insurance, you have cost of infrastructure, which is the rental cost, of your office premises, and then you have certain running costs.
Right.
What are running costs? Running costs like if the customers come into your dealership and in your store, they want to obviously buy a car, but there is a cost to wine and dine. So, for example, you offer tea, you offer you offer a test ride. There is a bit of promotion now going on with Mercedes, where they say if you want to try out a model, you can, rent it out for 2 days. There is a cost of insurance, which is a temp insurance or a 2-day insurance, because if you are going to drive, they'll ask for a full British driving license. And what they'll do is they'll ask you to bear the insurance cost, and then on that cost, you can take out the vehicle for a 2-day ride, without giving any deposit. It's a promotion that they're running. Then there could be costs in terms of petrol or diesel, fuel costs, as I would say. These are overheads, which means these are running costs which the business has to incur, whether the sale is happening, not happening, products is selling, not selling. Right? At some stage, what this will do is they will start looking at adding all these costs, and what the company, Nissan company, and say dealership like Hanan and Co. would basically decide that I need, at least say 25% overheads. So what that would mean, you have put your requirements that I need to make at least 25% profit to be able to cover all these costs. So how would that 25% be covered? So you look at 25%, and that would be the cost at which the car would essentially get sold from the dealership. That means the price of the car would become 16,600 plus 4,150, and that is the expense which the dealership would need to make sell the car at to make and cover just the overhead and the expenses that they are going to incur for selling this product to the customer. Right? So if this car is sold, assuming to the customer at 20,750, and you are making, what the next question would be as a director of the company is, how much of gross profit are you making? How much of net profit are you making? Right? So how do we calculate gross profit? Gross profit will be this amount minus, your selling price minus cost price would give you gross profit, or in this case, in percentage, if you look at, that will be called margin. And if you look at your net selling price minus your costs plus expenses plus overheads would essentially be your net profit margin, or net profit, and in percentage that will be net profit margin. Okay, so this is how we will look at some of the other terms, which is to say, by taking an example of, say, a budgeting sheet or a balance sheet, we will look at what are the other terms, things like net profit, and look at gross profit, and that will tell us, that will essentially tell us what your So in this case, what you're looking at is that you're coming across some new terms, which are things like expenditure. We're looking at net profit, gross profit, and that is how we will calculate that in the case of an organization. Now, let's briefly look at some of the financial reports that we look at. So financial reports would be, as I mentioned earlier, balance sheet, income statements, statement of cash flows, and they are generally, some sort of reports or statements which are produced from accounting as an activity. Now, balance sheet primarily represents a situation at any given point in time. Now, this is a compilation of accounts which is done primarily towards the end of the year, and it is a total of all the expenses broken down into assets and liability. So anything which is going to be adding to your bottom line or to your profit is going to be called an expense, and that would be a liability. Anything which is income coming in or money adding to your bank account or the company account would be classed as asset. So when you buy computers, when you buy PCs, when you buy a car, and they have a resaleable value, then in those cases, those kind of items would be classed as assets in the balance sheet. Now, when we look at assets, we can classify them further by saying current assets and non-current assets. That means, when I say asset, means items which can be immediately converted into cash during a current operating cycle. That means during a current financial year, and they'll be classed as current asset. Anything which cannot be converted into cash in the current year would be called as non-current asset. So when we look at, if you buy a piece of machinery and you've used it in the business, but you want to sell it now, and you find an immediate ad for it, and you realize some money for it by selling that machinery, that is called a current asset because you realize the money within the same financial year. But if you're not able to realize and sell that asset because you might need it in the future, and you are deciding to sell that after the work has been completed in, say, 2021, and then you receive the money, then the money being received in that particular financial year will be classed as, it will be classed as non-current asset because it is not coming to you in the same year. Similarly, current liabilities and non-current. So debts which are to be paid, that means expenses or bills which have to be paid within the same year would be current liabilities, and anything which is paid or owed to the company when you paid in subsequent years, that will be non-current liabilities. Now, Balance sheet typically consists of things like immediate assets and liabilities. It could have long-term assets and liabilities. You can also use balance sheets to calculate the cost and market valuation for a particular company. And also there are some supporting schedules which are produced. That means supporting information to explain the balance sheet is also produced when it is done. So when we look at, say, annual general report, of, say, Tesco, sticking to the example of Tesco, and if I just open that report up, you will see that this, when it is published, actually gives you, the current position of Tesco as a company, and it's a combination of, some three different types of statements, which are balance sheet, profit and loss account, and also the cash flow statements, which actually give you the performance of the company from a point of view of how the company is performing in the market. So let me just go back to that page where it shows, balance sheets and other things. So when we look at financial statement, this, is the balance sheet of the group for 2018-19, wherein it shows gross sales, revenue earned, tax which has been paid, dividends, capex is capital expenditure, and other bits. So this is an example of how it reflects the company's position in terms of sales turnover, operating profit, or profit and loss for a particular period in time from a particular geography. So this is the overall balance sheet for the group. This is just UK and rest of Ireland. This is Central Europe, and then they've done a balance sheet for Asian operations as well. So from a point of view, what we're looking at is just understanding what are these major types of statements and what their use is. So income statement, we look at summary of income and expenses as we've done, like in the budgeting case. It basically compares, a period in time between two balance sheets. So when I say how was the performance of the company in 2017 versus performance of the company in 2019, what you're going to do is compare the two statements to see when the profit, if the statement says that Tesco increased 50% in profits from its performance in 2017-18, that means you have to compare the two balance sheets to see in which year the company is actually making more income or more revenue. So when a balance sheet is looked at, this is how you look at a balance sheet, and it gives you the financial position of a company at a particular point in time, because it's a reflection of the summary of expenses, calculations, which is in terms of expenses, in expenditure, income from the last year. Because you cannot generate a balance sheet, for the future. You can only generate a balance sheet for, which is basically a combination of assets and liabilities for the previous year. That means what the company has made, what the company has sold, what the company has made in terms of profits or loss, and that is something which is reflected in the balance sheet. Now, why are these statements important? Let's look at the basic benefit of understanding why these statements are important. So when we look at some of these, basic things, what we need to be able to do is understand that these financial instruments, as we call them, are primarily useful for a couple of reasons. One, they allow you to analyze the position of a business at any given point in time. Is the business profitable, not making a loss? How much are we making? What is the net margin? What's the gross margin? Things like that. So you're looking at understanding the position of the company from a point of view of finances. The second is to understand how the business is performing. So one is the condition. Second is what we want to understand is the position in terms of the performance, whether the business is increasing, whether the business is making more profit. So as you can see here, if you look at the sales vis-a-vis previous year to next year, the sales have actually, so 17-18, the sales in Asia were 4.9 billion. But here in 2018-19, which is the following year, the sales have actually decreased by 6.2%. So, or basically there's a drop in sales. So this gives us an idea that whether the company's operations are profitable, not profitable, is it making money, is the business growing, is the business decreasing, what is happening, and that is something that you get to see, when you understand the statements. So it is the performance of the business and also the financial condition of the business is what you get to understand, which allows the board and the directors or people within the finance department to be able to make decisions in terms of investment, in terms of return on investment and things like that. So that is where what we want to do is understand this particular learning outcome to follow through in terms of understanding the importance of accounting for business. Now, there are one or two other things which we can briefly look at, things like ratio analysis. Now, there are different types of ratios. Once you have these statements, you can make a lot of different type of calculations. You can calculate different type of things, from the financial information. And some of this bit that we look at is in terms of understanding, the amount of investment, the return on investment, within the business. So when we talk about, ratios in, accounts, we talk about different type of ratios which will allow us to understand, whether the company is having the cash, not having the cash, making, is having more liabilities or, is making more profit. And those are the things that you understand from, ratios. So when we talk about accounting ratios, when we talk about ratios in general, it allows us to compare position of a business over a point in time with other businesses. So you want to find out, is Tesco more profitable or is Sainsbury more profitable? You'll have to do some sort of an analysis using ratios to find out whether Sainsbury is more profitable than, say, Aldi or Lidl or Tesco, or it's the other way around. And we use these ratios of different types, and there are, at this stage, we're not going to get into detail, but you're going to look at, there are 16 different types of ratios. They can be classed into accounting ratios, financial ratios, and these different type of ratios help us calculate these 5 criteria about the business. So how much is liquidity? Liquidity means, what is liquidity? So liquidity, any ideas on what is liquidity? So what is liquidity is basically, the ability of the company to be able to convert its assets into cash. So how quickly can the company, if the company is to go bust or the company is to close down operations, how quickly can they sell all their inventory or all their assets like computers, PC, infrastructure into and generate cash? So that would be called liquidity. That means the availability of cash or some sort of assets which can be converted into cash will be called, liquidity. When we talk about, liquidity ratio, we are basically going to be talking about, a ratio which is going to indicate whether the company's current assets will be sufficient to meet the company's obligation when they are due. That means you have sufficient money in the bank to be able to pay out all the bills at the end of the month. So liquidity ratio helps in understanding, what is the company's earnings, whether it's what the company can actually pay at the end of the month for those, expenses. Now, there is solvency. Solvency ratio basically measures the extent to which assets cover commitment for future payments. So sometimes you look at solvency of the person. When you look at credit reports and things like that, what we want to find out is the company solvent? That means, does the company have enough capital, resources, money, to be able to pay for any expenses that would come up in the future? So here the solvency ratio is basically used as an insurance policy if the company is to take out an overdraft or a loan, and what they would want to do is look at your accounts in the past to say whether the company has generated enough profits and enough, has enough working capital, or is it generating enough income to be able to pay off its liabilities in the future. Now, when we talk about profitability ratio, what we are looking at here is talking about things which are related to understanding the let's say the income and the expenditure. So here what we are going to use is basically talk about things which are to do with understanding 3 different types of things, which is things like what is the gross profit margin. That means how much of gross profit is the company making, what is the return on equity or investment, and then what is the operating margin. So sometimes what you look at is, in order to keep the business running, the company has to borrow money from the bank. So when the company has to borrow money in terms of overdraft, as we call it, working capital requirements, there the profitability ratios actually come into play. And then we have the repayment capacity and financial efficiencies, which is primarily terms to understand how the company's financial condition is, and if they repay loans, when companies buy machinery, make investment into creating a new plant or an industry, they will basically borrow money from the bank from a long-term basis, 10-year, 15-year loan. So what is the repayment capacity in the case of that is what we look at from repayment capacity ratio, and this is also one of the important outputs that we understand by looking at doing ratio analysis. So here at this sense, what I would say is you need to understand and go through some of these terms to just familiarize yourself with. We are not looking at doing any practical exercises in terms of understanding what this is and how this is used, but just to familiarize yourself with the terms so that you know what is the importance of accounting, for a particular business. Now, any questions at this stage? What I want to know is if you have any questions at this stage. I'm going to obviously send you a copy of this particular recording so that you're able to go through these slides, which is on Moodle, and
4, 7,
and then look at just understanding these terms from a reference perspective. And then if you have any questions or anything that you have not understood, I would suggest that you come back to me on an email, and what we can do is go through some of the bits with regards to looking at the assignment. Now, in the assignment brief here, if I look at specifically, what you have to do is pick up a particular financial statement, like from Tesco's or from any other retailer, and then explain some of these terms which are required to be done in order to cover the assignment brief. So if I just briefly open that up for us to look at, just to make sure that we are on the same plane. What I want to do is just briefly look at the assignment brief. Let's look at, so let me open this up now. So go into your course and let's open up the assignment brief here. So in the assignment brief, if you look at, there is a particular task which will ask you to look at, defining some of these terms. So it says the delegate need to know about some of the functions of business. Produce 3 information sheets for distribution at the workshop. That means we have to produce, one which is the importance of accounting for business. So a small handout that we need to create, which is a Word document which explains what is the importance of accounts for business. And that's covered in some of the slides that I've discussed earlier in this presentation. So why do we need financial statement, and what is the requirement of these financial statements, for a business? So these statements actually give us, the current situation of the business and also the performance of the business, and that is what needs to be elaborated. The second is describe the different functions carried out. So basically, that's the only bit that we look at, in this particular task that you have to cover, which is relating to assessment criteria LO2, Learning Outcome 2, 2.1. Explain the importance of accounting for success. So this is basically a Word document in which you are going to list out in a bullet point or about 2 or 3 paragraphs what are the reasons why businesses need, accounts, and how it is important for business in terms of financial decision making. And that, if you cover, would actually end up covering this particular task. So I hope with this you've understood, the Learning Outcome 2, and I'll look forward to catching up with you next week with regards to, obviously looking at starting Learning Outcome 3, and that would be to look at interpreting some of the accounting information from a point of view of an example. So here we are going to be practically looking at picking up an example and then interpreting either the profit and loss account or the balance sheet for a company, and then present it in the assignment brief. So till then, take care. Thanks for joining the session, and bye for now.